Recently, I saw a couple questions posed in a comment section asking these exact two questions. We bought our house in Kitchener for $185,000 in 1996, and it's worth about $900,000 now. Do we actually owe capital gains on that? A friend in the US said we would. And the other question I saw was, I keep reading about this Principal Residence Exemption. Does it really cover all the gain? What's the catch? And I've had these same questions asked of me as well. And there is confusion out there. So I'm here to help clarify things for you. Here's the thing. Canada does have a rule that can make the tax on your house completely disappear. It's called the Principal Residence Exemption. And it's honestly one of the best tax breaks available to any Canadian homeowner. But it doesn't work the way most people think it does, and it definitely doesn't cover everything you own. By the end of this video, though, you'll know exactly what's protected and what isn't. You won't be scared of a tax bill that was never coming your way, and you won't get blindsided by one that actually is headed your way. This is the exact thing I walk clients through here in Guelph, Kitchener, Waterloo, and Cambridge every time a sale gets close. Not theory, the actual rules, the actual forms, and the actual numbers. So let's start with the good news, because there is a good amount of good news here. Let's use the example I just told you about. That couple in Kitchener who bought their house for $185,000 in 1996. And let's use their example that it's now worth about $900,000 in today's market. That's a top line gain before expenses of $715,000 from when they bought their house originally. That's without the cost of moving expenses taken out. In this instance, they would net between $852,000 to $842,000 after all their expenses. Now in the United States, though, a couple in the same situation, selling the same home, only gets to shelter $500,000 of the gain like that from tax. Everything over it gets taxed. In Canada, if that home has been your principal residence the entire time you owned it, the exemption has no cap. Not $500,000, not $1 million. The whole gain is untouched. You owe zero in capital gains tax on it. That's not a loophole. That's the actual CRA rule. But here's the part almost nobody knows. The exemption doesn't apply itself. You have to claim it using Schedule 3 and a form called T2091 in the year you sell. Skip that step and you've made your accountant's life a lot harder for no reason. And I work with people in Guelph, KW, and Cambridge who are in very similar situations. Many of them who are in their 60s and 70s and perhaps older, and they've been in their homes 20, 25, sometimes 30 plus years, and they own outright or close to it, and they're trying to figure out what their next chapter actually looks like. And my focus isn't just the sale. It's the planning that happens before, during, and after the sign goes on the lawn. So why does the fear exist in the first place? Well, a lot of it comes from the news. In 2025, there was a proposal to raise the capital gains inclusion rate in Canada. That's the portion of the gain that gets added to your income and taxed. That proposal got canceled March 21st of 2025. The rate remains at 50% of the capital gain for individuals. Here's where people get confused. That inclusion rate has nothing to do with your principal residence. It only applies to a gain that isn't already sheltered by the principal residence exemption. Your house isn't even part of that conversation as long as it's been your primary residence. Not a rental of any kind. This is where the fear becomes expensive, not just uncomfortable. Imagine you're sitting in a home you've owned, let's say 25 years. You want to downsize, but you've heard from an American friend or maybe a US finance show that selling means a massive tax bill for you. So you wait and you wait. And every year you wait, you're still paying your property tax. You're still paying to heat and maintain the house that's bigger than you really need. Or perhaps it's not even meeting your lifestyle that you want or need. Meanwhile, the market does what it does on its own. And that fear is understandable. American rules really do cap the exemption at $250,000 for a single person or $500,000 for a couple. If your information came from a US source, it's not wrong. It's just not talking about us in Canada. But once you know your principal residence gain isn't capped here, that reason to wait really disappears. Now, the flip side to all of this, well, this is where the overconfident version of the mistake shows up. The exemption only covers the home you've designated as your principal or primary residence. If you own a cottage, for instance, that's a separate property. And when you sell it, the gain on it is taxable at that 50% inclusion rate. Same thing if you've been renting out part of your home, let's say a basement suite, or maybe it's a coach house or a unit above the garage. If you claimed depreciation on that portion and it's called capital cost allowance, that portion will not qualify for the full exemption when you sell. And here's the one that almost nobody thinks about until it actually happens to them. A big taxable gain, say from selling a cottage, gets added to your income for that year that you sold the home. If your income goes high enough, it can trigger OAS clawback. And for 2026, that's $93,400. So that's money you were counting on in retirement reduced because of the gain on a property you didn't even live in or you weren't using as a principal residence. So for a property to be considered your principal residence, it must meet the Income Tax Act rules. And the Income Tax Act rules include 3 requirements to be satisfied. Number 1, the property must be owned jointly with someone else or otherwise by the individual taxpayer. You are what's called the beneficial owner of the property. And number 2, the property must be ordinarily inhabited during the year by the taxpayer or spouse or former spouse, or even a child. Those are key words to remember. Ordinarily inhabited. You can be away and have one of these other people living there, but you need to fulfill number 3. And you must actually own the property in that year. What's meant by ordinarily inhabited? Well, the court has interpreted it to mean you normally occupy it as a home. And you can't say you have 2 primary residences, like a cottage for 6 months of the year and a house in the city for the remainder of the year. And the court doesn't define it by the length of time spent at the property. It's your declaration that matters. If you're trying to say it's your principal residence and you gain income from it, then it comes down to how much the house is used to generate that income. That portion, like let's say the basement suite, for instance, is taken into account, and the calculation is used to determine the percentage of the house that is used to earn that income. The key is you can only designate one property as your principal residence each year. And the third one I've already touched on, and that's the property must be designated by the taxpayer to be their principal residence for each year. Asking yourself, do I own a second property? Like a cottage, a rental, anything besides the home I declare as my principal residence or primary residence? If yes, that sale needs its own conversation with an accountant, separate from this one. Are any of them declared as a primary residence? And if I'm selling something other than my principal residence this year, what will that gain do to my income and to programs like OAS? That's not a question to ask after the sale closes. It's really a question to ask before you even list. Here's what I tell clients. Talk to your accountant before you list, not after you've accepted an offer. Ask specifically about the T2091 and Schedule 3 and whether every year you've owned the home is truly your principal residence. If you own a cottage or a rental property, plan its sale on its own timeline. Sometimes spreading a sale over 2 tax years or timing it around other income makes a real difference. And if you're not sure whether part of your home ever been used to earn income, even years ago, that's worth checking before you sell, not after. CRA will likely declare that portion of the house exempt from being part of your principal residence, at least during that period. So the next time someone tells you the government is going to take a huge chunk of your home sales, or tells you the opposite, not to worry because it's all tax-free in Canada, you'll know which one is true and which one only tells half the story. Your home, the one you've lived in, is about as protected as a tax rule gets in this country. What isn't protected is everything else that you own. And knowing the difference is what lets you actually plan instead of just hoping and with fingers crossed. So I'll see you in the next video.